Hey guys, this is Mike with Vant Trading with class number 12 of 20 of our beginners day trading course. Tonight, we're going to go over market profile and volume analysis, the neglected child. So this will end week number 3 of the course. It's a 5-week course that we're doing. And, we've gone over a lot of stuff, and today's class is going to be a class that is going to be pretty tough, I think. It's a tough topic, but it's just meant to be an introduction. Market profile and volume analysis is pretty detailed, and some traders have studied it for years before they even begin to master market profile and volume analysis. But really, if you're looking to become a professional trader, this is a topic that you're going to want to pay attention to, because it's something that is going to be important to get an edge, to be able to pull money out of the market on a consistent basis. The first thing I want to talk about, though, is look, becoming a really good trader, becoming an experienced, consistently profitable trader, is you got to really develop a system for yourself. And we kind of talked about that the first couple weeks. But, this is not something where, because I'm going to start getting into the next 2 weeks, how we trade, what our systems are, what our processes are. But it's not meant, you really don't want to copy someone else. You want to understand the process, you want to understand the topics, and you want to do your own research, okay? That's so important. You can't follow the same footsteps of somebody and then expect to get the same results, because there's a lot of experience, intuition that goes behind the trading. So that's why you want to really make it your own. Okay. And, you should have that journal that you're working with. You should have your mental journal. You should have your education journal. You should be making notes in each journal consistently, both times, because that's really important. You should be looking at both. So the key is, again, you want to become a consistent, profitable trader, and you want to develop and get an edge. And mentoring and modeling somebody that's done it, that's been, it's done it before, has gotten that consistent results. That's something you definitely want to do. So you can model us, you can model some of the ideas that we're talking about, but you got to eventually make it your own. And so that's really important. So let's get into the course. Okay, as usual, we start off with our habit of the week, and that's Relentless. And again, this being the last class, this is the last time that we'll really talk about this. But, Nick's really done the 3 classes of this week. I think he's done a great job introducing some technical terms and doing technical analysis. Getting into Relentless, this is the first time I've had an opportunity to talk to you guys about Relentless. This is an important habit or trait to have. I love this quote from Bruce Lee: "Don't fear the man who has done 10,000 kicks once. I fear the man who has practiced one kick 10,000 times." So, and that's so true. There's so many different ways, so many different indicators, so many different things out there, right? The key is to find quickly what is it that fits you, okay? And how are you going to get that edge in the marketplace today to trade and to master that? Become a master. Don't become a jack of all trades. Become a master of one, okay? So master, find what you're good at, put it in practice, and then keep on fine-tuning it and being relentless and just getting better at that, right? Don't be looking at trying to trade so many different types of strategies. I can't tell you, another trait of a typical new trader is that they try to find a couple different strategies, right? And they're trying to trade all these different strategies. They got all these different indicators. And then they hear somebody else and they're like, I'm going to put my focus over there. They're like a dog, right? So don't do that, okay? What I want you to do is I want you to focus on yourself, okay? I want you to focus on yourself and focus what you can master and what you're good at because that's really important. Now, I want to talk about the marshmallow experiment. Okay, many of you may have heard this, maybe you haven't, but I think it really hits home to really what sets successful people apart from unsuccessful people. In the late 60s, you had Walter Mischel explored self-control in children. And what he did was he took a bunch of preschoolers and he put a plate of marshmallows in front of them. And he told the kids, he said, listen, I'm going to get up and leave, and I'm going to give you two options. If you wait until I get back, you can have two of these marshmallows, okay? But, what you can do is, okay, you can ring the bell before I get back, and then if you do that, you can have one marshmallow immediately, okay? And we're counting the marshmallows and stuff like that. So, they had two options. They can wait until I get back, and they'd have two marshmallows, or they can ring the bell immediately, get the marshmallow, eat it, and they're done. Okay, well, this simple marshmallow test actually has laid the groundwork for the modern study of self-control, and it's been replicated many times over. And the results were just, to me, fascinating. Okay, years later, what happened was he came back. It really wasn't about what happened in the experiment at that time, right? So years later, when the kids were older, right? I think they're older than 16. He revisited the children that he administered the test, and he checked the results. And what he did was he interviewed the kids and interviewed the parents, right? And what he found was that those kids that had waited longer in the test, okay, for the two marshmallows were more likely to have higher grades in school. Matter of fact, it was like 97%. Their parents also rated them better at planning, handling stress, having self-control, and concentrating without getting distracted. So it turned out that the marshmallow test had predicted how successful the children would be later in life with some impressive accuracy. Now, what's really going on here? I mean, obviously, there's a lot of different factors in upbringing, nurture versus nature, stuff like that. But really, what we're kind of honing in is not really all of what's causing it. It's just the habit itself, right? So the common denominator is really the secret of a successful person lies in the fact that they form the habit of doing things that people that fail don't like to do. They're the outliers. It is only, it's the one thing that successful people do differently, okay, is that they are willing to suffer now so they can spend the rest of their lives as champions, right? Put in the work now, suffer, and then you can yourself reap the rewards that will be continual because you're building that foundation. Successful people also understand that to get the results most people don't get, they must be willing to do what most people are not willing to do. Okay, you got to be willing to do what other people are not, right? We've said it before 100 times. If you're following the crowd, right, then you're doing it wrong. Okay, because the majority of the people are sheep, and you're going to be headed down over that cliff, and you're going to get the results what the majority of people get. And the key is, successful people, they consistently make progress by pushing through where everyone else gives up. I talked about that, man. You got to have that burning desire. You got to have that drive, right? And this is my favorite. And, I had my mentor kind of tell this to me when I was first starting. The brick walls are there for a reason, okay? The brick walls, they're not there to keep us out, right? The brick walls are there to give us a chance to show how badly we want something. They are there to stop the people who don't want it badly enough. They are there to stop the other people. Okay, so don't get upset when you run into a brick wall, when you see an obstacle. They're there to really weed out the people that just don't want it bad enough, right? There's a price to pay for success. And I always say it all the time, to the people we're mentoring. Look, it's tough, right? If everybody could do it, then the rewards wouldn't be as great. Okay, just keep that in mind. So, trading, we went through the numbers and we're going to go through them again today. The numbers to me is just another wall, right? The fact that 90% of the people fail at trading is just a brick wall. How badly do you want it? And that to me is really the story of relentlessness. Okay. All right. That's enough of that trait. Let's get in now to the meat and potatoes of really what we're going to talk about today. What we're going to talk about today is market profile. And I want to really start off, when we talk about market profile, I really want to start off and talk about the story of Bill. Okay. See, Bill, I kind of want to give you this story here. Bill used to be a livestock operator, and he did, used to sell livestock and stuff like that. So, he had some understanding of markets and things like that and pricing. So he decided to become a trader. And what Bill did, right, he read everything he can find, and he decided to do futures trading. And he studied all the technical models, read all the manuals, he did market analysis, he attended seminars, all this stuff. Well, the very first day he started to trade, he woke up at 6 a.m. and he was like ready to go, right? And, he went on, turned on his quote monitors, and he prepared for the market open. And like he always does, he opened the Wall Street Journal, and he wanted to see what the bank traders and the brokerage analysts were saying about the foreign exchange market. See, Bill had been watching the Japanese yen closely because he felt the recent depth of coverage in the news would surely reveal some really good trading opportunities. The US dollar was expected to record new lows because the US economy was slowing. They were experiencing consistently negative trade balances, and that was forcing the yen and other currencies higher. And all the news articles he read, and everybody he saw was bullish on the yen. A good friend and fellow trader, called him and commented on how the currency should rally that day. So Jim, he went and checked the 20. He had this technical. His edge was using the 24-day channel model. He was also using the 16 and 30-day moving average crossover model. These are two long-term technical indicators which he frequently used his trading based off of, and they were both generating buy signals. Okay, so Jim glanced over his charts and volume numbers and chewed on the end of a pencil. And what he did was he had been looking at the yen for a couple days, and his own personal analysis was that, man, he was thinking the yen was just looking weak, man, and he looked like it was an opportunity to sell, right? The volume was drying up, but price still was an upward channel, was moving higher. But the activity seemed to be decreasing to him, and there had been really no substantial moves to the upside in over a week. So he knew from his ranching days that less volume was significant. So when he would auction off his livestock, see, the price would continue up until the last buyer had bought, right? And then, when the auction was near its end, the bulk of the buyers would have dropped out because they would fulfill their inventory requirement or the price became too high. Basically, in that process, when no one was left to buy, the auction was over. So Jim, leaning on that analysis, he read everything again, and it just looked like the yen, just didn't understand. But all the indicators, all the fundamental analysis, all the analysts were pointing that the yen was going to be strong today. Okay, how can all these professionals be wrong? So he waited for the market opened. The yen opened, rose a few ticks, and then it stalled. The floor traders were acting on recent bullish sentiment, but the buyers that had driven the yen up for the past month were nowhere to be found. What happened? Well, the yen plummeted and crashed, and Bill sat on the sidelines. Why? Because he got stuck with analysis of paralysis. Plus, he kept on saying to himself, how could the majority of the people be wrong? Well, remember, 90% of the people out there trading are wrong. Okay. So don't get caught up in that, analysis by paralysis. Plus, what we're now going to introduce to you that I would say the majority of people don't even talk about is that there's really three types of analysis to analyze the market. And really, Nick talked about the first two of them, and the majority of the people that, look into trading talk about the first two, right? You got fundamental analysis and you got technical analysis. The problem is the third one is what most of the beginners and 90% of the traders don't look at, but it's what 90% of the professionals lean on, and it's called market generated analysis. And so that is the market profile, that is volume profile, which is what we're going to talk about today. Okay. So, again, the beginner traders, where 90% of them lose, are so focused on fundamental analysis and technical analysis. And if you went and talked market profile, or if you went and talked volume profile, they would have no clue what you're talking about. So let's get into it. Market profile, the hunt, as I like to call it. A little history on market profile. Peter Steirmeyer was a trader on the CBOT, the Chicago Board of Trade. He was a futures trader, okay? And, all market profile is it's a unique charting tool that enables traders to observe the two-way auction that drives all market movement and the ebb and flow of price over time. It's a way that reversal patterns in the herd behavior can really be fine-tuned. Okay, so really market profile analysis, volume analysis, for us is the key tool that we use to get an edge to extract money from the market on a consistent basis. Okay, see what happens is in market profile is you're focusing on what the environment is. What's the environment for the hunt, right? What's in the area? What are you hunting today? Okay, is there enough of a population to hunt? What's the habit of the prey? Is there an edge hunting in this particular area or this particular security, right? And so it's completely different than what we've talked about before and what other people use, which is traditional technical analysis from candlesticks. Okay, so market profile we use to really look at, okay, where is some of the value areas? Where are the big boys trading right now? Where are the pivot points? Where are the inflection points? What's the point of control? Where's the value areas? Okay, and so if you ever look at, we go through some of the charts, and sometimes I'll pull up a chart that's got, all these different areas and zones and stuff like that, right? Well, where I get my levels is not just from support and resistance, right? It's also using volume and profile, market profile analysis. And that's what we're going to just touch upon and introduce to you today. Okay, let's get into market profile, the building blocks. Well, there's three building blocks to market profile. There's price, there's time, and there's volume, what some people also like to call opportunity. Okay, price really advertises, it's an advertisement of opportunity, because there is a clear distinction in the market between price and value. You probably heard this saying I say all the time, only price pays. Okay, price, not your feelings, not your thoughts, not your opinions. Price is the only thing that matters when you're comparing it to value. Now, time regulates all these advertised opportunities, okay? And volume, okay, volume measures the success or failure of these advertised opportunities. And, keyword being opportunity. So some people, you'll hear, if you're talking market profile, call what's, the basic building blocks, the PTO, right? Price, time, opportunity. But I like to use price, time, volume, because volume is really what is the key for me when I'm looking at market profile analysis. Okay, market profile analysis uses what's called the efficient market theory. And really what that is, is the market, the market is an efficient um, uh, marketplace. And so the market is always looking to seek balance between price and fair value. Okay. So your job, part of the job of, market profile analysis, is the market price in balance or imbalance? Okay. Are we in balance? And so the market is constantly going up and down between different volume areas to find that balance. That's what the market's always looking at. So one of the key beliefs that you want to add to your, we talked about your trader beliefs you should be adding, is that the market's job is always to seek balance. You need to understand that. Okay. So, the general rule is once a market is inside a value area, it will likely stay in that balance and explore the inside range of that value. So if the market is in balance, then what will happen is, like I said, it'll drift higher and lower, okay, until it stops inside a previous value area that the market is seeking. And it's always making judgments. So price and time and volume it's the market's way of making judgments. So the market is always seeking value based on supply and demand. Okay. And that's really key. Okay. The market is, you got to remember supply and demand rule everything. Okay. So the market is always seeking value based on to that supply and demand dynamics. And we'll get back to that in a minute. Okay, so let's talk about, because most people, when Nick talked about technical analysis, he went over the charts, he talked about candlestick charts, and we all use candlestick charts and we use market analysis. Okay, but I kind of want to talk about them and compare them and talk about how we kind of use both, because we use it a little bit differently. Market analysis originally was, it's used a lot by futures traders because futures traders, it's a little bit different animal. And futures traders are constantly, it's an auction style market and it's constantly moving, and supply and demand play really big roles in it. Now, so, we don't use market profile charting as much, though we do, when we're trying to build out a composite profile, but we'll get into that in a separate class, okay? But market profile charting approach is different from the candlestick approach. See, market profile is looking at where's the majority of the business, where's the majority of the shares taking place, okay? See, most scientists, when they're analyzing data, they analyze it on a bell curve type distribution. And it's the same thing really with market profile, right? It's, using on a bell curve type distribution. So really market profile is really nothing more than a scientific way to organize data. But the difference is time is constant on horizontal axis and price now is on that vertical axis, okay? And see, the majority of people online, they understand a candlestick chart, right? And they just point their little, they point, they click, and they buy, right? Based off a candle. But, and then they're trying to draw their zones and maybe support and resistance and stuff like that. But the problem with that is that really they're not even taking consideration, 2/3 of the story. Okay, because 2/3 of the story of what's going on underlying in the value of the market is completely being left off. Because when you look at volume on a candlestick chart down, as a histogram versus volume in a volume profile, tells a completely different story. Okay, and we're going to really break that down for you as we, get into it. But really what market profile does is it smooths out the aberrations, such as the high volume ticks you get on the open and stuff like that, right? Because then that skews the data. But what we want to know is how much volume was traded at what price, because you have supply and demand. So I would want to know as a trader, more importantly, I would rather know how much volume was traded at the most consistent price, which is really what we're going to look at as the point of control as we get going. Now, if you wanted to look at what a typical market profile chart looks like, well, here's what one looks like. Okay, and you can kind of see that bell curve distribution, right? And the point of control for whatever period you're looking at is the biggest bar where the most volume has occurred. It's the price where the most volume has occurred. That is what's considered the point of control. And you can kind of see now you have this volume kind of showing up in a different way, and you have this distribution for the stock showing up in a different way. And then it also shows you, for whatever area you're looking at, that what the value area is. And the value area is where 68 to 70% of the data for that period resides. That is what you call the value area. Okay, moving on. Now, remember, I know this is maybe a foreign concept, something new, but remember, 90% of the traders don't make money. Okay, so it drives me crazy because people that start off, right? They'll pay for a course, they'll maybe even get into a chat room and other traders are talking about trades, right? And they're in the chat room. I just love it, man. Everybody's making money, right? Oh, I've been in this stock since here, right? I've been in that stock since here. And then, you as a new trader, you're trying to follow along and you're doing your own trades and you're losing money, right? But everybody else, it seems like everybody else is making money. Well, the numbers don't lie, okay? Trust me, majority of people are losing money, and just because somebody says they're making money doesn't mean that you're an outlier and that they're really making money and everybody's making money and you're not. It's bullshit. Okay. So, don't pay attention to that stuff, right? Focus on yourself, focus on what you're doing. And I know a lot of this stuff, we go back to that chart, it looks Greek. And some of the stuff's going to look Greek to you and maybe hard to understand. Don't let that, deter you. Okay. Again, this is meant to be an introduction, but I'm going to do it in a way that you're going to get some chart patterns that you can start trading with immediately. And you're going to start understanding now, Mike, now I know why you talk about the opening prayer. Mike, now I know why you talk about VWAP, right? Because I love it. VWAP, another professional indicator now everybody's using. The problem is 90% of people don't even understand what VWAP is. Okay, so we're going to kind of put this together at the end of the day, so you're going to be able to actually have some, pretty good trading basis. And then if you want to go further down the rabbit hole of market profile and volume analysis, we'll be able to do that, right, in a separate class, kind of a breakout class. And, you can really, it's something that's going to take you a little while to grab, and it's going to take you a little while to build a basis on. So I don't know necessarily you should be going farther into this than more than what we're introducing for you today. Okay, look, the purpose of the market, it exists to solely facilitate trade. And it does this by auctioning from high to low, low to high, in order to find that area where the trade can be facilitated. Okay, that's the market, right? I mean, and think about it in terms. Think about if you owned a grocery store, right? And you're selling peanut butter. Okay, well, if you put the price of that peanut butter that you're selling it for too high, well, shoppers aren't going to buy that peanut butter. Right? And they're going to move on, and you're going to have a lot of peanut butter left. So what are you going to have to do in order to move that peanut butter? You're going to have to lower your price, right? Now, if you lower that price too low, what's going to happen? Well, it's going to sell out right away. You're going to be out of peanut butter. Why? Because buyers are going to recognize the value and say, oh, this is great. Plus, you're going to have some people, what you would call arbitragers, come in and say, you know what? I can buy peanut butter from this guy, right? Because he's so stupid selling it so low, and turn around and sell it online to this dude over here, right? And make the difference. So what's going to happen is you're going to have to find that tip. You're going to settle on that middle ground price that gives you that perfect balance, that gets you the most money for your peanut butter, but still, doesn't blow out your inventory so you don't have any inventory left of peanut butter. And then, you make your customers mad. Right. So, that's really what the market's about, facilitating that, right? High, low, high, low. Now think about it too. If you're a grocer, let's say you're a family run grocery store and you have this, Walmart comes into town. Okay. They're the big box. Well, Walmart has some competitive edges that you don't have. Well, what does Walmart start doing? They start selling peanut butter as well, but they sell it at a lot cheaper than you. So what are you going to have to do? When you have a big seller of peanut butter, you're going to have to do what? You're going to have to lower your price and to be able to sell that peanut butter and take less. Now, if you lower your price, does that mean you're going to run out like before that, and all the value buyers are buying up? No, because the price is going to stay lower now for a permanent time because you have a big seller that's in the marketplace. It's the same thing in the market, right? So you're always looking for value. But sometimes when, what is value? Well, value is when that price is lower, the price is lower than really what it's worth to the marketplace. Okay, but if price stays low too long, then what happens is it's not necessarily value, it's a new valued number. Okay, and so you'll have to take that into consideration. And that's all the market is. The market facilitates buyers and sellers. So the big picture, market structure, okay, is nothing more than visible evidence of the actions and behaviors of the market participants. So all you're doing when you're looking at the market is you're looking at, evidence of what the actions are of the participants. Okay, so you have the big picture is you're looking at the market structure. Then you're adding trading logic to that market structure, which is why does the market behave the way it does? And that comes really from your experience. Okay. And then you're adding time, which is the ultimate market regulator. Okay. And that's the big picture. And again, you're constantly, what you're trying to do when you're looking at market structure is find where is the value in value areas. Okay. Because the areas of the market profile bell curve showing the greatest depth is where the trades have occurred the most. You don't get to see that when you're looking at a typical volume bar or you're looking at a typical candlestick bar. Okay. There's good opportunities to buy below value, but guess what? Just like an example with the grocer, they don't last long. Okay, because price will move quickly through not low volume traded prices, as you'll see. And I'll give you another example. Let's say that you want to get into skiing. Okay, so you're new to skiing. And of course, since you're new to skiing, you don't have the equipment to actually go and ski. So what do you got to do? You got to buy ski equipment. Well, the price of ski equipment can get pretty pricey. And what happens is, do you think the price of ski equipment is constant throughout the year? The answer is obviously no. Because what will happen is during the summer months, are many people thinking about skiing? No. So what happens typically to the price of skiing equipment when the demand is low? Well, it goes down. So, if you want to buy ski equipment cheaply to get started, the best time to buy would really be during the summer when they discount the prices down. But will the prices stay down there forever? The answer is no, because time, remember what I said, time regulates opportunity. This is a perfect example. Because if ski equipment makers constantly kept that price at that level, that low price, they would never make any money. So the time of summer months when the demand is low, regulates that opportunity, regulates when that value is going to be lower. I'll give you an example in trading, which I used to, when I first started trading, we used to trade, it was simple relationships. And this trade was so simple and easy. I just couldn't believe everybody didn't trade it. But, when, I don't know if you remember Toys R Us, it was the biggest national toy store. They're actually out of business now, I believe. But Toys R Us, you could buy Toys R Us going into September because it was very cheap. And then guess what happened as you went up into November? Toys R Us shot up every year. It was like every year but 1 year. Toys R Us, like over a 30-year period of time, would go up in October, November, and December. Why? Because 80% of their sales was done during Christmas time. And so it brought the attention, it brought the demand of traders to that stock, and it showed up as a relationship value in the trading of that stock. And that's one example. That was really the first example I got to value area and market analysis, and those relationships still exist if you know how to look for them and how to know what is a true value area for a particular stock and for a particular market. Because what we're going to learn is high volume and low volume nodes. And what you're going to learn is, when you see stocks that have traded a lot of price, they typically become a magnet, and gravity kind of pulls traders to that price, right? And then what happens in low volume nodes, where there hasn't been a lot of shares traded during that period of time, typically traders and prices quickly go through that area. Okay, so but remember, if price, like I went back to the grocery store example, if price remains low for an extended period of time, it's no longer an opportunity. There's something that has fundamentally changed. Now, what we're trying to do with really this market analysis and volume analysis is we're looking to find where are the larger institutions, where are the commercial participants, right? Because they are huge and they leave footprints in the market. I'm sorry, but the Robinhood traders, the retail traders, they don't move the market like everybody likes to talk about. They're not trading enough shares. Who moves the market is the institutions, okay? Because they are trading large volumes of share. It's also the commercial participants in the marketplace. So really what you're doing with market profile and volume analysis, you're trying to find where are those footprints that they are leaving, okay? Where are they? And so you can trade with them instead of against them, okay? Because that's going to give you an edge. And there's a certain amount of shares that need to be traded every single day. It used to be easier when it was level 2 and there wasn't this high frequency trading and all this, dark pools and stuff like that. Level 2, it's harder to see the footprints of the institution now, though it still works to a certain extent. And again, TPO, remember I talked about time, price, opportunity, measures the level of imbalance at a certain level for a stock. And imbalance and balance is going to be something that we're going to be hitting upon constantly, okay? Because you need to know when a stock's in imbalance. Okay. Now, if we can identify imbalance before it corrects itself, then obviously us as traders, well, we can make money on that. Now, what you need to understand and what you need to realize is the market is an auction. And the auction market theory defines a value area, and I talked about this before, as a place where 70% of the value is traded. Okay. Now you have acceptance. Traders accept a stock at a certain price when there's been a lot of volume that has taken place at that price, right? And that's what we call a high volume node. Now there's been traders have rejected a price when there's not a lot of volume at that price. Okay. And that's a low volume node. Traders need to understand the market narrative, because if you're going to be a trader, right, you need to understand the narrative of what the market's saying to you. Okay. Now, the trader with the edge is the one who understands the market narrative the best, and that's the professional trader. So what I need is for you to be able to understand that. Okay. Now what I want to do is I want to talk about volume, okay, as a part of the market profile. Volume to me is one of the most important indicators, or one of the most important things you can look at when you're trying to compare a stock or a marketplace when you're trading. And it just amazes me how traders just really, it's kind of, I call it the most important neglected stepchild, because it's just amazing to me how many traders just to refuse to even look at volume, or really most of them don't understand volume. And you know, if you understand pricing and market pricing is a basis of supply and demand, then you know volume is really one of those things that kind of it's one of those indicators that can show you whether or not you have demand. You know, and when you're looking at the demand side, other than price, really, you know, it's more about demand, and volume kind of shows you, you know, where the demand is. And you know, it's like gas, you know, to keep a fire burning and to really get those flames to go up, you know, if you pour gasoline on that fire, man, it's going to go. Volume to me is the gasoline. And when you're talking support and resistance areas, you know, to me, volume is the great equalizer, and it really is, because you know, how many times do you see charts? And I'm going to show you some charts that when you're trading and it looks like that, you know, especially if you're trading a breakout, if you're not looking at volume, and then you know, you're really doing it backwards, okay? Because the majority of breakouts are failed breakouts, and you know, I would say the majority of those failed breakouts are just low volume breakouts that could, you know, traders who are experiencing losses could have really avoided. So volume, you got to understand volume, especially when you're looking for support and resistance to be broke. And when you're trading, I don't care what kind of trading you're doing, if you're not looking at volume, you're doing it wrong. Now, one of the measures that we use to measure volume in a stock is what's called RVOL. And relative volume, which is what RVOL is, compares the current volume that you know that you're looking at to the normal volume for that period of time. So if you're looking at a 5-minute bar, you know, our vol is going to be based on what a typical 5-minute volume bar is going to be for that stock. You know, or if you're looking at the days R vol, then you're going to look and, you know, compared for the time frame that you're looking, the volume you've experienced in this stock compared to what the average volume is, that's going to be the R vol, and it's displayed as a ratio. So typically when we're looking at stocks, one of our rules that we're looking at is the R vol has to be above 2.5 for a stock to be in play for us, because what we're looking for is typically trading a stock that A, has a catalyst, and you know, so it's going to move something, it's going to move that stock for the day, and to show that traders really care, and that traders that are having the stock in its sights and that the stock is in play, I want to see an R vol that is above 2.5. So if you haven't, you know, so if you have an RVOL of 1, well, it's pretty much trading what it normally trades, right? So if you have RVOL 2, it's trading twice as much volume as it normally trades. So, you know, the key is, you know, I can give you an example. Last week we were trading, and we went over this on our market show, how we were looking to get into BABA, and BABA was at an important inflection point. It was an important support resistance area, but it just wasn't going anywhere, and it was kind of not, it's just kind of sitting there, and the RVOL was 0.66. So, you know, we weren't trading BABA right there because, you know what, the traders weren't there. Now, I'm not saying that a stock that has an RVOL of 0.66 cannot go up, right? It's just that the risk to reward for us is not where we want to be. So for, you know, everything that we're looking at from a trading perspective is we don't want to be in a stock that has an RVOL of 0.66 because it's just not for us. So, you know, there's a lot of, depending on what charting services you have, what kind of, you know, again, broker service you have, most of them have RVOL in there. If not, you should consider paying somebody to code that in for you. So RVOL, definitely important to look at for stock, just so you know that traders are going to be there. So I'm going to use you a couple examples. And I talked about BABA, right? And this is an example on the daily chart. So if you look at this daily chart, you know, BABA really, you know, in this 310 area, Nick had talked about this area all along going through here. And really, you know, look at the volume on BABA and look where, you know, yes, did it break up out of this consolidation? It sure did. It went up to 319.32, but did it hold? The answer is no, not at all. And the reason is because, you know, the volume was not there, right? The volume wasn't there for the traders to hold it. And then look where Baba eventually ended up. So, you know, you got to have volume. Again, for us, I'll give you another example. Here is Square, a stock that we trade a lot, right? And you can kind of see Square was breaking out here, but the volume was very weak. You know, if you compare, you know, if you look at Square run-ups and breakouts, you typically have some, you know, more extreme volume pickup in here, right? And, you know, that has a little bit more success. This breakout here had absolutely no volume, very light volume in here, and it ultimately failed. So again, you know, for us as traders, you know, volume is one of those important indicators that you want to look at. On the flip side, we were trading JD and an important inflection point right in here around the 65, 50, 66 level. And here we got that increased volume. You can see the increased volume, and we got a sustained break and run. So, you know, this is an example where volume came in, pushed above an important level, and off that stock went. And the volume not only went up during the breakout, it sustained itself for, you know, an extended period of time. So that's a nice little break in JD. Here's an intraday chart on Walmart, right? And you can kind of see, look at the prior day, right? Look at the volume in Walmart here, right? And then at 11 o'clock, you know, we started to get some increase in volume, and we got this big explosion bar up right out of through this congestion zone, which was a nice extended rally. It was really extended volume. The volume stayed extended for the rest of the session, which enabled a nice little extended breakout. This is what you want to see on a breakout, because traders are showing up, traders are there, and that's going to give you a better idea. And I talk about this all the time when we're talking on our trading show. Okay, I talk about this all the time. You know, to get through a really important level, you need to see a lot of times big share volume come in. And a lot of times you won't get it. It'll bump, 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 and fail. Bump, bump, bump up, and fail that important level, right? And they just can't get through it because the volume's not there. And then it takes a big bar, some big mover to come in and push us through that level, and then it typically runs. And so you can see this example in Walmart. Okay, another one, Riot, right? Look at this. You know, nice level right in here. Look at the volume increase on this breakout flag here. Volume took us up, nice little run up in Riot. And, you know, again, if you look at the prior days, do you see, look at the volume here, okay, at the end of the prior day compared to the volume during this day. So Riot was in play. Nice little extension day up from $4.20 all the way up to $6.60. So nice play in Riot, and the volume was there to kind of show the way. Peloton, look at Peloton. You know, nice little, you know, again, increase, nice little lid. You had this nice little lid from the day before, right? You know, we opened up in range, and, you know, we kind of fell back down into range here, came back up, butted our heads, and then we got that increased volume bar, and what happened? Pushed us right through, and off we went. Okay, so, you know, again, if you're not looking at volume, then you're doing something wrong, because it's, you know, it is the great arbiter right here. And then here's another one on a nice little flag from Myrna, right? You had the, you know, nice little drop in volume on this flag, by the way. So, and that's another important point when you're looking at volume, right? Not only are you seeing increased volume on the buy side and on these breakouts, are you seeing decreased volume on the pullbacks? Okay, you should be seeing decreased volume on pullbacks, increased volume on the breakouts. And this is a perfect example right here. You got some nice little flag, nice little decrease in volume, traders taking a break from this extension bar up out of the range, and then as the traders are resting, then all of a sudden they start coming back in, piling back in, and then they break through this triangle and this triangle, and off they go. Nice little extension range up for a quick 6 points, and that's what you're looking for. And then, of course, again, took some rest, took off some volume, started to bring it back up. Okay, but then we started getting, you got to be careful too. Time has a play as well. We said time is the greatest arbiter of opportunities. Well, time of day, after 11 o'clock, what tends to happen to volume starts to drop off. Lunch hour, you shouldn't be trading during that period of the day, but you also got to be careful how you're analyzing that part of the day, because you want to make sure you're comparing apples to apples. So, again, another nice little breakout here in Myrna. And this is a nice little chart, right? This is a nice little chart. And you can kind of see it, guys. You can see it, how it starts to fade off, right? Starts to fade off, lower lows, right? Lower highs, excuse me. And then all of a sudden, what do you got? You got this lower volume, and then the volume starts to round out, starts to pick up right about here. And then the volume picks up all the way through. So, to make this climb here from 120 to 130, again, you want volume to confirm that the buyers are coming in. And you get that extended run, and it really doesn't give you, again, on this pullback, what do you see? Lighter volume. So that's what you want to look at when you're looking at volume, and the R vault was very high. So when you're looking at breakouts, when you're looking at trades, volume, if you're not looking at volume and it's not part of your thesis and part of your market strategy and part of your edge, well, you're doing something wrong without a doubt. So, looking in, when we're talking about market profile, we're also talking about volume profile. And, really the volume that we just were looking at, and if we go back, right, if you go back a chart here, this volume that we're showing you on this chart here, this is a histogram volume, right? And you have your time axis right down here. So, it's not the best way to look at volume, and volume profile is going to show you a different way to analyze volume and a different way to find out where market participants are. Now, with volume profile, I've been using volume profile for at least a couple years now, and it's really been, it's been great. And with volume profile, again, most people, they look at the volume at the bottom of the chart as a histogram. Professionals, on the other hand, they look at volume on a vertical axis. So instead of volume being on a horizontal axis, volume's on the vertical axis, right? And you can find a bunch of different things by looking at volume profile on a vertical axis, to the point of how is not volume by time, but volume by price is what you're looking at. So what you're looking at with a volume profile analysis is where was the most shares really traded. So what you're going to see when you're looking at this, you're going to see there is going to be a price typically that has the largest volume bar for that period that you're looking at on a volume profile chart. And I'm going to show you one in a minute. That largest volume bar by price is going to be what's called your point of control. Okay, the point of control from where the bears are in control versus the bulls. Okay, and the value area that we're going to highlight and show you is where 70% of all the prices sit. And that's, knowing your value areas is going to be very important. And we talked about this before, knowing your high volume nodes and your low volume nodes, very important. Okay, so the high volume nodes is where the most significant trades have occurred. It's really, you got a strong gravitational pull to the high volume nodes. Low volume nodes is really where prices were rejected, okay? And they've received little attention. And typically what you'll see is, when a price is in play, when a stock is in play, a market's in play, you'll typically see price shoot through these low volume nodes pretty quickly. They don't offer up much resistance because not a lot of traders have really been there. And what you'll see in volume profile analysis is really a story. The market is just really searching, trying to go from one high volume node to the next. And they're trying to go from one value area to the next value area. And again, knowing where these value areas are, knowing where the point of control is, knowing where, the most of the participants, what price they're in at, is really an important thesis and an important point of information for you as a trader going forward. So here's a chart that we've used on the eSpy minis, okay? And this is using volume profile analysis, okay? And, the E-minis, the ES futures on the S&P 500, it works very well. And you can kind of see in here, right? You can kind of see, where, for each day, you got your value areas in here, right? And you have the largest bar. This is the point of control for that stock today. Okay. And then, you can see, the volume is off to the, on this vertical axis, and it really helps, right? It really helps, because if you look at a stock right here, okay, think about this. Okay, if you look at this stock, this stock really, the volume for the day, really, not many shares were purchased, right around here. A lot of the transactions occurred, right, on this composite profile down here. And this is where you have a very important point of control sitting right at this level here for the composite profile that we're looking at this. And you can kind of see, if you look through here, and you can kind of see this is, this is a low volume node right in here, right? You got these low volume nodes right in here, and then prices typically go right through those, without much harm, right? And so understanding how to analyze these, this stock, you can kind of see right in here. It gives you a nice little value area where the price did drop off for the next day. Then you see a change of character right in here towards the end. And we're going to talk about how you can look at profile analysis, see where the majority of the trades are happening, and then you can see where is it going, where kind of give yourself a little bit of a prediction where the market's going to go. Now, if you want a little bit of a less complicated chart, this is a chart on TradingView. And this was a chart that we had put together on the SPY, and you can kind of see interesting chart, right? Because look, if you look at this chart here, this is a daily chart on the S&P 5 on the SPY, which is based off the S&P 500. You can see the point of control right in here, and look at this level. This happens to be a major inflection point, right? And I also put it in there. The bears are in control below this point of control here. So, this is where we're kind of talking about it on the show. If we continue down this pathway to the 200, we're in a bear market, right? And you can kind of see the little bit of a support here to the point of control. And then, almost dropped down to 200 down back in middle November. And then off we bounced right back up. So if you look at here, you can see the majority of the shares for the SPY are in this, in this 315, 310 to, 354 level. And so it's really, that's where the majority of the participants are. And, up here, you're kind of in open air. So, again, what do we say about low volume nodes? We can't typically fly right through a lot of those. So, the SPY sitting up in open air again. Pretty interesting way to analyze the market, and you can see some really good value areas, really good support areas that really provide support on the daily and intraday charts. So it's a different way to really look at the volume, look at participants, look at demand, and it's a way to look for where are the professionals, because they're leaving footprints, and you want to trade in the direction of the professionals and how they're trading. It's really important. So looking at that, again, I might mention something that maybe kind of confused you a little bit, is eventually what you're going to do with market profile and volume profile analysis is you're going to create what's called a composite structure. Okay. And it's really where you're going to take a chart and you're going to bring a couple of days together, and you're going to constantly build on that composite structure to where, it's going to build on top of each other. And again, the purpose is find out where the market or the security you're trading is in balance, and what's the key inflection points, because it's impossible to know, without doing a volume profile, market profile analysis. It's almost impossible to really see that stuff. So, really, the point of control and VWAP, because, we've talked about VWAP, Nick brought that up. And again, if you remember VWAP is the measure at which most trading desks are measured against, how, buying throughout the day for institutions. Okay. So you have this point of control that we're looking at. And we're also looking at VWAP. So these are two things now. This is two tools that we have in our toolbox that we're constantly using as professionals to really, analyze the markets. And what's interesting is technically, they both represent where the most trading have occurred. Okay, VWAP is the price at which the most volume traded for a specific time frame. The point of control relates to time and is the price at which traders spent the most time. So people often get confused time with volume and think that price the market trade at the longest in time would have the most volume, but that's not the case. Okay, and that's why we're using both point of control and VWAP. Okay, because they're both important when you are really looking to analyze the market and really see and find out the relationships and where the key inflection points are and where, really we are. And what you got to understand for traders, the stock market is a story. Okay, the market is a story. Okay, what areas did the market accept price and what areas did it reject price? Where is it in balance? Okay, we talked about, when we're trying to find, we analyzed it to a market hunt, right? It's, where is the prey going to be? How do we know it's there? When are we ready? What's the confirmation? Where are the big institutions going to be playing in here? And is it worth it? Is this really something we want to be in? We talked about increased volume is accepted price. Decreased volume is rejected price. Okay, not many traders, if you have a low volume node, not many traders have traded that stock at that price. Okay, so you as a trader, want to trade the story, okay, and understand your market. And a lot of traders, they're just trading based off of levels. They're just trading off of basic information, and they're getting whipped around because they're missing at least a third to 2/3 of the story that really would help them understand, what's going on. See, your goal, because I know a lot of this stuff is complicated, but your goal is not to be the best trader, okay, but to be better than most. Most people don't want to do the work that is required. The key is, if a bear is coming, if you're out in the woods and you're with a group of people, right, and you're running, right, and a bear's coming after you guys, the key is you're good, you're going to be safe as long as you're not the slowest runner. As long as you're faster than the slowest runner, that bear's not going to get you. Okay, so again, right here when we're talking about the markets, the goal is not to be the best trader. Don't let perfection get in the way of being consistent. Okay, the goal is not to be the best trader, but be better than most. Okay, and again, you have an edge in that if you're willing to put the time and effort in. Most people don't want to do the work that is required. And I kind of equate it to, we're from Baltimore. We've traded up in New York. We got, down in Key West, got an office, and, but we've always followed, being a football fan, we used to follow, Ray Lewis was one of our top players that, that was part of the Ravens, and I really like to use Ray Lewis as an example here because, a lot of people consider him to be one of the greatest linebackers to ever play. I mean, he was player of the year in 2000, 2003, won 2 Super Bowls. And he really was legendary, known for his preparation. And see, when Ray came out of college, really nobody talked about him. As a matter of fact, there's over 20 teams that passed on him in the draft. I mean, he wasn't a really big linebacker. He was undersized for what a lot of the linebackers were back in the day. You know, Michael Singletary and all that other great linebackers. But, you know, what set Ray apart and what made him great was because he didn't have the physical attributes. Yeah, he was fast and stuff like that, but he was different for his time coming into the game. Now the linebackers are completely different, but still. And what made him different, what made him great, what made him legendary was that the hours and hours and hours and hours and hours he spent studying film and preparing for the game day. He would study players' tendencies, right? He would study their statistics. He would study the game plans. So what would happen is when the game started, he knew exactly what the opponent had used in every possible situation, what formations each play was run from, who were the key components. He had a game plan in mind for every possible outcome. But the key is after the kickoff, he didn't think about any of that stuff. He didn't think about play charts or playbooks. He didn't have any of them. He didn't have to do that because he had spent so much time reviewing and knowing and recognizing patterns that while he was in the moment, he could act intuitively and recognize patterns quickly and direct the defense. The opposing coach could change their strategy and plays within every game and attempt to throw players off like that. But the ability to recognize such changes in the moment in time and still be able to make that stop is what made him the Hall of Famer and gave him the consistency that he had. Okay. And that is the same exact thing in trading. And that's why you got to understand, first off, you got to have the tools, right? You got to have the work and the preparation, but you got to make sure you're doing the right work, the right preparation, right? Because, you know, you can be consistent, you can be legendary in trading, and you can make as many figures in income as you want. It is all possible. But the key is it's not going to happen following people in the chat room. It's not going to happen going and doing what the herd does. It's not going to happen just dipping your little pinky toe in, because look, you can make trades in profitable trades for a short period of time. You know, you can even do it maybe for a year or 2 years, but guess what? Eventually the market has a way of catching up and weeding out the people that are not willing to put the work in. So if you're not growing as a trader, if you're not adding to your arsenal, if you're not understanding volume points, if you're not understanding inflection points, if you're not willing to do the time to understand the market structure, then and take the time to recognize the patterns, then you're going to be like all the other traders, and you're going to be you're going to find yourself doing something else. It'd be best just not to waste your time. Okay. So, you know, it's important. We've seen a lot of different traders come through, and we've seen the cycle over and over again. So what I want to do now is start really adding to your arsenal, and I want to start taking and bringing some of this stuff. So I want you to go and understand market analysis, and I want you to go understand market profile, and maybe dig more and learn more. But I want to give you some of the end result stuff that, some of the patterns that you need to look at. And we're going to give you some structural reference points. Okay. Because it's just like anything else. Remember, I talked about, in the beginning of the classes, right? In the first week, I talked about it. I equated trading to really like an airline pilot. Okay. And I talked about how our airline pilot, is off course 80% of the time. Okay. As they go from point A to point B. If they're flying from New York to Key West, they're off course the majority of the time, but they have the reference points to bring them back and in focus so that they can get to their destination safely and on time. Okay. And that's the key with the market. You got to have structural reference points to understand what is going on in the market. because you got to be like Ray Lewis. You got to be like an elite athlete like Michael Jordan. You got to be prepared for every possible outcome. If you have an outcome happen, you start your trading day and then something surprises you in a market and you don't know how to handle it, then you know you are not prepared to where you need to be. Okay. This is where you need to make a decision, okay, to become a professional trader. And being a professional trader doesn't mean you work for some fancy fund or that you know, have some, you know, really established job, you know, in the Wall Street or anything like that. No, a professional trader is someone who makes a living trading the markets, that is dedicated with the diligence needed to become consistently profitable. Okay, not somebody who's going to take the 80% way, the 90% way. It's going to be lazy. It's going to sit in the chat room, going to let other people feed their mind. That's going to be, you know, try to follow somebody else's trades. No, somebody that's going to make trading their own, going to learn consistently with Kanai, constant and never-ending improvement, and build out a trading plan that's going to make them successful. Okay. And part of that is going to be a decision by you to become a professional trader. And if you're going to become a professional trader, okay, you're going through now some structural reference points. You need to answer two basic questions when you're getting prepared for the market. Okay. Which way is the market trying to go? Up or down? So, which means basically another way of saying who's in control, bulls or bears. Okay. And how good of a job is it doing in attempting to be directional? Okay. Because a market can go up, it can go down, and it can go sideways. Okay. What do you think happens the majority of the time? It goes sideways. Okay. So your job as a professional trader is to be able to understand, get an edge so you can understand what the market is doing, and you could answer these two questions. Now, the first reference point we have is what they call the pre-opening call. Okay. Now, if you were to look at my charts, I spend a lot of time, and the last week, by the way, of this class is going to be going through how I set up charts and how we set up charts and Nick sets up charts and where we put our value zones and how we're trading based off our charts and stuff like that. Okay. So one of the big things that I look at it this way. If I'm getting ready to hunt for the day and I'm getting ready to trade, okay, I need as much reference points as possible. What's in control? Remember the two questions, right? You know, where's the market going and what's the conviction of it going that way? Okay. And so we're trying to answer that. And really, who moves the markets? The big money does. The institutions do. Okay. Well, big institutions typically have direct access to the pits. Okay. And what will happen is in the pre-market prior to 9:30 when the market's open, if you're trading the U.S. markets, it's called the pre-market. And so it's the first piece of information you're getting that day as far as whether or not, you know, who's in control, right? Are buyers in control? Are sellers in control? It's the first piece of information you're getting. And what will happen is, so that's why typically you're going to see on my charts, I'm looking at the pre-market high, I'm looking at the pre-market low, and I'm looking at the pre-market point of control. Now, we know that there's not a lot of people, the volume's very down in the pre-market, but you still can get RVOL calculated for stocks that are trading pre-market. So I can still see where there's an elevated investor interest in a stock, number one. Number two is it's just reference points. Okay, reference points for me to understand, and it's the first piece of reference point that I'm getting. So it's very important for me to kind of analyze where it is. Another piece of reference point is right before the market opens, and Nick talked about this with imbalance orders. So what happens is you get these orders that come in that tilt the market. So you may have a lot of heavy buy interest coming in from big institutions that the market makers need to work off, right? Or it may be heavy sell orders. So 5 minutes before the market opens, 3 minutes before the market opens, you may see some really important swings, and you need to pay attention to some of those swings, and you need to pay attention to if there are imbalance orders out there and how it's going to affect your stock and affect your market. So it's the first reference point that we have. Okay, the second reference point we have is the open. Now, anybody that has traded, that I've mentored, or anybody that sat with me, or sat in on our show, okay, knows how important, and already knows that the opening print is sacred to me, okay? Because the opening print, first off, beginning traders don't look at it, okay? Professionals do. And it's another, now it's like the kickoff, right? It's the kickoff for the market, and it's the first print that's been printed. And basically it's going to be the line in the sand, the initial point of control to me for the bulls and the bears. Okay. So when you have the opening print gives you that battleground. And then you have, again, for the first 15, 30 minutes, you have what's called price discovery, and you have this initial balance, okay? And what's interesting during this initial balance is one extreme typically will hold the day most of the time. A lot of people don't know that. So what you do need to do is the quicker you can identify which one they are, then the quicker and more profitable you're going to be as a trader. So a seasoned trader will have enough information to identify where the market's going and which extreme will likely hold. So, when I'm looking at that opening print and I'm comparing it to the previous value zone, okay, and I'm comparing it to, if you're doing a daily zone, right, and you're looking at a daily composite, then obviously the prior day's high and the prior day's low is going to be something that's important to look at, right? And also the prior day's close. So if you were to look at my chart, you would always see the prior day's high and the prior day's low right on that chart. Because again, it gives me more information about who's in control of this stock, the buyers or the sellers, the bulls or the bears, okay? And it's going to give me good inflection points going forward. Now, there's 4 types of opens that are going to give you a clue on directional conviction. Okay, 4 types. The first one is the open drive. Okay, and the open drive is the strongest, most definitive type. Market participants have made their decision prior to the open, and they send signals in which, enables a trader an opportunity to position themselves early. That's the key, right? Be out pattern recognition, reference points to understand when it's going to hold and when it's going to go, so you can position yourselves to profit off of this drive. Now, if the market in an open drive eventually comes back through the open, then traders pretty much know that this is an invalidated pattern. Are we able as traders, even with all this market profile and volume analysis and, pattern recognition, are we going to be 100% exact? Is this like a science that we're going to be able to just really run with and not ever have to worry? The answer is no. Right? The key is to put the odds in our favor so that we can recognize these patterns, get in earlier before, with the smart money, profit and lower our risk. Okay. The key is, as traders, is to put the odds in your favor. Okay. And that's what we're doing here. Now, the open drive, like I said, is the strongest and most definitive type. It's the one you want to see, right? Because you can get some good gains off this. But the problem is, right? The problem is, how often do you think that happens? Okay. It doesn't. Not much, but it does happen, right? So, make sure that you're recognizing this pattern. So to recognize the patterns, look at a couple of them, right? Here's Roku. Roku, everybody knows, if you've been following me, following the trade show, and that's the reason we do this, by the way, okay? The reason we do our stock show at 1 o'clock, on YouTube is we do it not really for viewers in the public, but we do it because it's an internal feed that goes through our internal system for all of our trade desks. Okay. But, ever since we went public with it and people have been following it, we do it so other traders can learn. So the opening drive play, as you look here at Roku, you can see, Roku I've talked about a lot of times, and Roku has opening drives all the time. And typically we call it the elevator ride up, can usually get 5 to 6 points within 2 minutes and I'm out, right? So, and we've learned how to recognize those patterns, and you can learn how to recognize those patterns here. So this is a perfect example of an opening drive where it's just open, and you can kind of see here, Roku goes from 236 up to about 248, 250, within a heartbeat. Not a bad trade right off the get-go. That's an example of an opening drive. Now, another stock, let's look at the opening drive on the downside. Chewy. Okay. Now, if you look at the day before, right, you can see we are opening outside the zone, dropping and just driving down. Okay. And that's an important point. Okay. So we're outside the value zone, right? We're opening outside the value zone, driving down. So we got new sellers in play, and, it's a straight drive down from about 67, 68 down to about 62. Nice little trade, opening drive, and that's why they work so well. Now, the next one that we have, the second type, is what's called an open test drive. It's similar to the opening drive, except the market lacks the initial confidence. Okay, so the market opens, the stock opens, then tests beyond a known reference point, right? So, it goes past that known reference point, the prior low, prior high, pre-market high, pre-market low. Make sure there's no new business to be done in that direction, then reverses the auction swiftly back through the opening print and usually drives right through. Okay, right for one direction. And again, these trades I have pointed out over and over and over again on trades that we've traded on, on our trade show. So let's use an example. AMD, you can kind of see opens up, they drive it below the previous day's low. Okay, come down into, they test, and then they start making these new highs. And then what happens? They drive it back up through the opening print, and then it's a drive straight up when the volume kicks in. So that's a perfect example right there. Okay, so perfect example of on AMD. Another one. Okay, another one is to the downside, DraftKings. So they open it, pierce it up, they test the upper zone. Okay, they test up. And then what do? They didn't find the buyers. They drive it back down, pierce through the day's lows, come back up to the prior day's lows, reject it again, come back down, and down we go. Okay. So again, another open, take it up, bring it back, shoots back through the opening print. That opening print VWAP can really be some really good, when you put this stuff all together, really puts in a really good understanding for seeing and recognizing some of these patterns. Now, you also have what's called an open rejection reverse. Okay, that's where the open happens, trades in one direction, then returns back through the opening range. And again, less conviction of its direction. Initial extremes, they generally don't hold over half of the time in an open rejection reverse. And understanding that the less conviction, patience, and discipline will wait for the market to rotate back to you. Okay, rotate back to you. So you can kind of see here in Roku did that, right? Came back down, tested, went right back through, rejected, came back through, opening print again, and off it went for, right back up through the zone. Another one, Disney. Okay, you can see Disney went back down, made a new low, drove itself right back up, open rejection reverse. Okay, and then you look at another one, you can see right here, Square. Okay, Square, another, again, open, they initially drove it back down, and then they rejected it, and it reversed and came back down, back to the opening print, only to go right back up through it and to go further into the afternoon. So that's the open rejection reverse. Okay. And, you got to understand these patterns, man. And you can see how they can be traded. You can see using your indicators, using your opening print, using your previous value, understanding where the value zones are, understanding when the market's being initiative, when it's being rejected, understanding when the market is in value or in balance. Okay. Now, we also have what's called an open auction, where there's no apparent conviction at all. Now, that's what you have the most of the time, right? No apparent conviction, not sure, a little choppiness. And it really depends, though, when you have an open auction, where the opening happens in relation to the previous day's range. If it's inside the range, that's where it opens and stays. That's what's called an inside day, non-convictional day. And what'll happen is you don't want to trade those days, because you're basically, if you ever get on trade a stock and you're basically feel like you've just been going sideways, watching paint dry all day, that's an inside day. Okay. Now, an outside day is the fact that the market is out of balance, means that there's a good potential for a dramatic price move in either direction. So you can have an open auction with an outside day that can get some action here. But the key is with an open auction that's in range, inside, sentiment is not changed and sets the mode for a non-trading or neutral day. And we kind of talked about that earlier. Now, an out of range open, their first impression that there is no direction again. But the fact that it opens is outside the range of the previous day suggests that the new buyers and sellers are already there. So it gives you a clue. Given it's out of balance, suggests there's a greater chance that it could have more of a drive day. So the open, again, open is important in a clue in dictating where this stock could possibly be going. Let's give you some example. Inside day in range. Well, here's an example of the SPY. I trade the SPY a lot, okay? And the SPY here, you can kind of see, has its inside day. It opens within range. There's a previous high. There's the previous low. And it stays within the range of the previous day. This is called an inside day. And you don't want to be trading inside days unless you're scalping. And we'll get into that in another class. Okay, open auction in range. Another inside day is Tesla. Okay, you can see previous high, previous low. They opened it within the, pretty much almost at the point of control. They tried to drive it down, maybe thought they were going to break it out, couldn't get above this high, kind of came up to it of the previous day, came back down and kind of, kind of really squeezed in there, and you can kind of see where the volume kind of went with Tesla. So again, a day that, unless you're scalping some of these positions, really don't want to be trading because the odds are not in your favor. Now, an example of an open auction out of range, here's an example where Lyft kind of opened down, so it suggested possible other traders, or now newer traders, are showing up, but then kind of drove itself back up into range and gave you a nice little trade as it went back up through the opening print. If you look at the next chart, you got another example of Disney. Now, Disney, again, kind of, did this little reverse action, open, came down, rejected, reversed, came back into range and broke through the highs. So again, kind of understanding that, some other new buyers and sellers are starting to show up. So understanding opening's relationship to the previous day is really important. It's a measurable way to see whether sentiment has changed or it hasn't changed. Open in or out of balance helps a trader gauge the key day time frame elements. What's your trade risk opportunity? Estimating the day's potential range development, okay? All of this you're getting from understanding how your stock is opening, how it's acting, whether or not it's hitting a value zone. Is it in value? Is it in balance, out of balance? How is your stock working, okay? Because each day you're going to start with expectations. that's going to serve as guidelines based on market's past performance. Traders studies factors such as long-term market direction, right? And then they fail to look at the value area placements, compared to the opening range. Once the market opens, right? Once the market opens, then, you're starting to look at, your intuitive mind pops in. So you need to be able to recognize some of these patterns. You need to be able to see and know, right? Within that first half an hour of trading, you should know, if you're a seasoned trader, where your stock's going and really, what kind of ranges you should expect. Okay. And you really can't get there unless you can recognize patterns, unless you can recognize where the value, whether it's in balance, out of balance, and where the values are. Now, opening within value is acceptance. Okay. Markets that open within value is accepted markets that are in balance. So sentiment hasn't changed. So wherever the sentiment was before, the sentiment stays. Okay. Trade risk and opportunities are low. So obviously, if the risk is low, we said opportunity equals risk equals reward. Okay. So you're rarely, going to exceed the length of the previous day's range. Okay. So you want to stay out, be careful. It's not going to help you. Markets could be breaking out of balance and the risk opportunities could be going up. That's when you want to look at, but you got to know where those ranges are. It's really important. And then finally, again, visualization, recognizing patterns. I kind of want to give an example. So, I think, I can't remember when this was, but Gary Kasparov was a world chess champion. He challenged 59 school children in a separate game of chess all at once. So he set up all these tables in a gymnasium in the school, and he invited 59 kids to play him in chess. And he was playing them all at the same time. So he had to go from table to table to table within the time limit to basically quickly make a move. And think about it. He could only do that, right? Because you got a certain amount of time. I think he had like 10 seconds at each table, okay, to get within the time limit. So he had to be able to go at the table, look at the table, look how the chess is set up, look what his opponent's moves were, and recognize a pattern, okay, and make a move based off that pattern. He beat every child but two. Two of them were really good, and they played him to a draw. So he didn't lose any of the games. Amazing. And it was all about recognition of patterns. So as a trader, you need to get good at recognizing patterns, but you got to know what you're recognizing. Okay. So you need more experience in identifying trading setups using market profile, using volume profile. Okay. Because that's what's going to help you become a professional trader. So, it's all about look at what the professionals look at. Support, resistance, previous value areas, high and low volume nodes, inflection points, right? That's what all professionals are looking at, okay? They're also looking at what the process, look at what the professional's process is. They're using market and volume profile. They're identifying pattern recognitions, okay? So you got to have processes that are the same, okay? And then look at the tools that the professionals are using, okay? I'm a big believer in looking at the open, looking at the opening call, okay, which is the pre-market, looking at the point of control, and looking at VWAP. Okay, that is important. You want to become a consistently profitable trader. Okay, and so part of your tool chest needs to be the opening print, VWAP, point of control, and the opening call. Okay, look into pre-market, look into the prior day's value zone. Okay, what's the high, what's the low, what's the close? Okay, all of this stuff is important. And then studying and recognizing these 4 opening print patterns and recognizing them over and over and over again to give yourself an edge. Okay, you can do it. You can really do that, become a really good, profitable trader by doing that. So I know there's a lot here from maybe a little bit Greek to some people. Maybe there wasn't enough here for some other people. I get that. And we're going to kind of go a little bit more detail and a little side class to get you guys, more, into, what is market profile and how to really open it up. My goal was to make sure you got enough out of this so you can start affecting your trading out of the gate. So when you're starting to put together and you're starting to put your trading plan together, which is what we're going to start next week. Okay. You start putting your trading plan together. You start trying to find an edge. Now you got some tools that you got in your toolbox that, other people aren't looking at. And that's what you want. Okay. You want what other people aren't using, because the majority of the people, I don't care what they say, are losing money. Okay. Don't follow the people that are losing money. Okay. I hope this helped you. I hope you have had a good holiday weekend from Thanksgiving and stuff like that. And look forward to talking to you guys next week and get a little bit more in detail and start developing our trading plan. Safe trading, guys.